Good morning, everyone, wherever you are in the world, and welcome to Capital Without Borders, the brand new podcast brought to you by Interpolitan Money. We're discussing how money really moves across the world and why global finance is often far more complicated than it seems. My name is Kate Edwards, and I'll be your host. You can listen to this podcast on Spotify or you can watch us on YouTube. Don't forget to subscribe and follow us on LinkedIn and Instagram at Interpolitan Money for updates. If you'd like to find out more about how Interpolitan Money can help you or your business, please email us at partnerships@interpolitanmoney.com. Now, for today's episode, we're talking to our very own Jack Miles, who is the Chief Risk Officer here at Interpolitan Money, and he's going to talk to us about everything cross-border capital, from trust and risk to regulation. Good morning, Jack. Thank you so much for being on today.
Good morning, Kate. Thank you.
Today, we're going to be talking about cross-border capital, trust, risk, and regulation. So we'll get straight into it. My first question for you is, capital is being held and deployed at higher values and larger volumes than ever before. From your perspective as CRO of our globally operational EMI, what are the most surprising risks that institutions overlook when managing the flow of funds across borders?
So there's one risk which comes up time and time again, but actually I think we're seeing a change. I think we're seeing a big shift. So historically, when we spoke to CFOs and CEOs, the biggest surprise they would have is that we were interested in their business. Their business is simple. It makes sense to them. Why would we need to know? Why do we need to know about capital flows or payment flows? We just need to hold the funds, hold it as bank or alternative bank or payment service provider, and then just pay out as they say fit. But of course, it doesn't quite work like that. We've got these really strict global regulations we need to operate under, predominantly anti-money laundering rules. And therefore, we do have to know. We have to feel comfortable and confident that actually this is already legitimate business. Now, of course, 99.9% of all the flows that any institution ever sees is, of course, legitimate business. The same rules apply regardless. They don't know until they know. Now, why do I think I've seen a bit of a shift with that? Because historically, what would happen is a large complex transaction would take place and the payment element was an afterthought. 3:00 on a Friday afternoon, the deal is done. And then suddenly your financial institution has held the money. They haven't released it. And they're asking all these questions. And why do they need to know? Just get it done. But actually, the shift is happening because a lot of our clients themselves operate in financial services. They are themselves financial institutions. They understand what's going on. Even the ones that don't, they understand the world. They understand how this is operating. And so they're much more engaged. They're telling us in advance. They're preemptive. And actually, sometimes they're even looking for advice. How can we make this more efficient? How can we get this on time? It's really critical this payment goes or is received. What do you need to allow that to happen? So I think what we need to do more as a financial institution is really call that out in advance, because there's a huge benefit to the underlying client and huge outcome, positive outcomes on the back of that.
Yeah, absolutely. Now, not all operational environments are created equal. How do you lay the foundations for a strong yet scalable internal regulatory culture that works across multiple jurisdictions whilst serving the unique needs of our local clients?
Right. This is the challenge. Okay. We cannot pretend it's not, but actually I'm blessed with some like-minded colleagues, and it's not just because I'm speaking to you. It's a truth. We spend a lot of time looking at regulation, reading the source books, speaking to one another, speaking to our regulators, all for one thing, to try and get as consistent as possible. Now, one regime over here and one regime over here may say two slightly different things. But what they're trying to achieve is often the same. So how can we develop a process? How can we develop an approach which is the same? Which means that we're operating in two different environments. Our clients operating in two different environments, but the experience they get is the same because we understand what's required. We go beyond what the rule tells us, but what does it mean? What's it looking to achieve? And then how can we interpret that? And the next point is then to say, well, do we understand our processes and what they're trying to achieve throughout the business, throughout the department? Nothing frustrates me more than someone saying, I was told to do it, or I don't know, it's always been like that. Why has it always been like that? Understand. And that comes from the top to the bottom. Allow challenge through. Some of the most effective process and outcomes we receive, which then has a lovely knock-on effect through the business, that actually come from junior staff saying, I don't think that's right. Why do we do that? Well, have you considered this? I think in my day-to-day role, I think this would be a better way to do it. And allowing that challenge back.
And how important is trust and collaboration between sales, marketing, customer experience, and compliance teams when it comes to managing risk while still delivering good outcomes for customers?
Yeah, it's huge. It's everything, isn't it? We've all been in that situation where you get passed from department to department. You can only speak to this critical person, but then you're at Wednesdays at 2 till 3. When you call them, the phone doesn't work. And then when you call back to another department, they just say, it's not my problem. You have to speak to them. That is mind-numbing, isn't it? That is the worst possible outcome that can happen. But why does that happen? Well, it happens because of a lack of trust, because colleagues aren't looking after one another. They're not trying to support across each other's teams. They're not looking for the best outcomes for the client. So if I think about our client services team, do a phenomenal job. And they have these wonderfully engaged relationships with clients, but they can't do that unless there's a wider payments, operations, compliance team, marketing teams, finance teams, sales teams behind them, supporting them. So when they need information, they can go and ask. Or when another department needs help and support, they can step in. It's about collaboration and having that trust that people are looking after you. They sympathize with what you're doing, because if that happens, the machine starts to work more effectively. And that only produces a good outcome for the customer.
Absolutely. Some commentators would argue that regulation and compliance constrain and limit growth, whereas others believe that they create opportunities. Have you seen examples where regulatory frameworks have enabled genuine innovation in cross-border payments?
Yeah, so I think, first of all, anyone who says point blank, binary, regulation and compliance is a hindrance to business is just wrong. Yeah. I'm going to come out and say that it's the truth, because the world is more complex than this binary answer, yes or no. And our regulators do such a difficult job. I have so much sympathy for them. Like I said, spend a lot of time speaking to them, a lot of time dealing with them, a lot of time helping them and assisting them. It works both ways. They're phenomenally curious about financial services, about the type of clients we have, how we're supporting, how we doing the best for them. Because they know if they set the right environment, everything else comes after. They create these good foundations. So if I think back to what is a good foundation, I think about the Payment Service Directive, the electronic money law, electronic money regulations that created effectively what we see today as fintech. They were the base level. Now, was it going to develop in the way that UK and European regulators saw and what it's developed into now? No, they could not possibly have imagined this. But it has, and it's wonderfully exciting. And there's so much innovation. If we think to more recent times, well, actually, how's this more closer to us? We think about our recent development in Canada. So historically, the Canadian payment regime was a simple registration with FINTRAC, which is the Canadian Financial Intelligence Unit, like the National Crime Agency here in the UK. And that was it. Nothing else to it. So you had lots and lots of small firms setting up, but no one could really challenge the Canadian banking system. And we know that in the UK, that challenge produces most amazing products and services that can never have been thought about 10, 20 years ago. So we've looked at the changing regulations as this MSB registration goes into a PSP registration with the bank in Canada. And now there's more things we have to do. We have to think about operational risk. We have to think about conduct. And we thought that's an opportunity because that creates a more maturing market and one which allows great innovation, allows structure and stability, and allows a bit more challenge. And with challenge comes better outcomes, more product services. And we kind of want to be the heart and center of that.
Absolutely. Financial crime prevention has been at the heart of payment services for decades. Yet it appears that compliance at the service level is always one step behind, especially with new sources of wealth from emerging economies and alternative industries. Do you think that the industry needs to rethink how it approaches AML to make it more effective rather than simply a compliance exercise?
Absolutely. We often think about these things as a kind of magic bullet. There is one thing that will solve this, and it will all go away after that. But life doesn't really work like that, does it? There's also need to be recognition that financial crime and money laundering is always one step ahead. The people involved in this are phenomenally good at it. They're innovating, they're creative, they're pushing boundaries. Now, they're pushing all the wrong boundaries, they're innovating the wrong way, then they're creative for the wrong reasons. But they still are. And we're always one step behind. This is not a new thought. This is a thought that's been around as long as there's been the controls to have around money laundering and their desire to tackle this. And then you hear, well, we'll just plug in AI. But that still doesn't solve the problem because what does that actually mean? I think we come back to the idea that it shifts, and there is a graduating shift I see in the financial services sector predominantly, which is you still need human beings at the heart and center of this. But you need to use tools to A, make things more efficient, B, ensure that you're being more targeted where you can, and C, ensuring that you have a balance between your growth, your clients' needs, and your compliance needs. And they can exist in harmony if you get it right. One doesn't need to trump the other. They can actually be mutually inclusive one another. I think when we speak to our clients, what we see is they respect this. And actually, they would have an issue if we weren't asking difficult questions at times. If we weren't doing what they know we have to do, because that is what's required to mature business.
And speaking of our clients' expectations, we're very firmly in a digital economic era right now. How do PSPs, EMIs, and traditional banking institutions balance the enforcement of regulation in a world where clients demand faster, cheaper, and more personalized financial services?
Yeah. So every year we hear there's more regulation coming out. And trust me, it is exhausting. There's always a new thing you've got to consider, and you've still got to do the old stuff. And there was more last year and the year before that, and the year before that, and the year before that. And then we often hear from government, especially the UK government recently, saying actually we need to cut red tape. The two are not existing at the same time. The trick is to understand what the requirements are and develop those requirements with your clients in mind. So it is hard to keep on top of this stuff. It's super important to do so. And it's super important to do so because actually some of this regulation that comes out, and a lot of the regulation that comes out, is often quite logical. If we think back to operational resilience in the UK or consumer duty, a lot of this is just good governance. You should be doing this stuff anyway. And so actually regulation can be really helpful to kind of give you frameworks and constructs to work to, because that's just how you create a sustainable business.
Focusing on people, we've seen several high-profile cases of individuals being so-called debanked, despite not breaking any contractual rules. How can providers balance legitimate risk concerns with providing fair and equal access to financial services in a time where geopolitical and geoeconomic lines are being increasingly blurred?
we don't need to name names here, but we can all agree what we've seen in the last year or so is definitely a case of banks and other financial institutions shooting themselves in the foot. There's no doubt they could have handled these things better, and they should have done. Rules are changing largely on the back of this, as we know, in late April. So where there is a debanking event or a de-risking event, that the client is given now 90 days to effectively find alternative solutions versus 60 days. But does this fundamentally fix the issue? Well, in some ways, yes. The reason that was often given around the kind of 6 days notice was typically quite vague, outside of risk appetite. What does that really mean? Now it will be a little bit more detailed, which will allow challenge. But should banks and financial institutions ever got to that point, there's always going to be an edge case. There's always going to be a client that you take on, and 3 years later, their business has fundamentally shifted and changed. And now it is outside of the risk appetite. But it should never come as a surprise to the client that they're suddenly being debanked, or de-risked, or they're having their account terminated and given 60 or 90 days notice. They should already have those conversations with their relationship manager. And what worries me here is that historically, there is a feeling in industry that sometimes it was down to fees, and the term risk appetite was being used as a throwaway comment, when in truth, compliance is expensive, reassuringly so. But was it a case the bankers then, or the financial institutions then done an assessment and gone, it's just costing us too much money to hold this account, so we'll just discard this, give 6 days notice and let them move on? What we should be doing is having a more frank conversation with our clients. What is it that they do? How do they manage their risk? How do they allow us to manage those risks? And actually, what is the cost of managing that risk? And if it's simply the price is X and the client doesn't want to pay that, well, that's a different story. But I see it differently. I see that most clients will actually happy to pay a price if they understand the risks that institution is taking on their behalf. And that, I think, creates much better outcomes. And it creates long-term sustainable growth for both parties.
Now, to round this all up, let's look ahead. What will matter most in maintaining trust in cross-border capital exchanges? Alignment between regulators and advances in technology, de-risking policies, or a return to relationship-led services?
Oh, a bit of everything, I think. A bit of everything. Can be greedy and say everything. Alignment in regulation and regulators, that happens a lot behind the scenes. We know there are changes afoot regard to the FATF recommendation 16, aka the travel rule, the amount of data that's shared in a payment. That will help. Additional technology, that's definitely going to help. How do we allow our team members to surface information quicker, to make more informed decisions? How do we allow a client to engage with us in more efficient ways? AI has a massive part to play here. When I speak to banks and other institutions, very, very large institutions, they often say they've oversold the AI dream. And what they envisage isn't quite what's happening now, but they're happier now because what they're seeing is staff use AI as an agent to support them, to effectively act as an executive assistant or a researcher, and allow them to cut to the chase quicker. So when they're having conversations with their colleagues about really important points which have meaningful impacts on clients, they can just get to the chase really quickly. But it's that last point, isn't it? There always needs to be a human being behind it. We want to deal with humans. When things are going well, it's great. I just need to get that done. I need to move that capital. I need to get this sorted. And it works. But life is complicated and the payments world is complicated. We make these really difficult things feel quite simple on surface. But there's lots of moving parts. When it goes wrong, you really want to speak to a human being. You really want to speak to an expert who can walk you through and explain what's happening, the what, the why, the how, and actually how we then get around this, how we move forward, as opposed to computer says no.
Amazing. Well, thank you so much, Jack. That was really, really interesting. And I'm sure that everybody will find that really useful as well. Thank you so much for coming on today.
Great. Thanks, Kate.
Thanks.
Appreciate it.